Welcome back. Markets are still digesting the latest turn in the tariff story. Yesterday, U.S. President Donald Trump sent letters to 14 countries outlining looming tariff rates, announced a pause on reciprocal tariffs by 3 weeks, and announced big tariffs on two of the country's largest trading partners, Japan and South Korea. Let's find out how that's affecting markets and other topics as well. Joining me is a familiar face, Lesley Marks, Chief Investment Officer at Mackenzie Investments. Lesley, thanks for coming in.
Good morning.
What's your take on how markets digest the ever-changing flow of news that we get from Washington on tariffs?
Well, I think it's been, in general, a big surprise to see that markets have really taken the latest turn of events with respect to tariffs in stride. Of course, we had a small sell-off yesterday, but markets look a little bit firmer today. And I think what markets are basically saying is they don't believe that those larger tariffs that have been stated in the letters that the president has sent to his major trading partners will actually come to fruition. And so the markets are really continuing to give the benefit of the doubt when it comes to tariffs and feel like the next 3 to 4 weeks until August 1st will continue to be a key time for negotiation. I think the other point, a bit of a nuance, is who the letters didn't go to. The president continues to negotiate heavily with the European Union. We didn't see a letter going to this trading bloc. And so I think people do believe that the United States is close to announcing a deal with the EU, which would also be an incremental positive for markets.
Are investors becoming complacent with major indices at record highs at a time when there's so much unknown about where all this is going?
I think absolutely there are signs of complacency in the market. When you look at the VIX or the Volatility Index, you see that we are at below historical levels or averages for the VIX. So that shows low volatility in the context of what could potentially be a key inflation driver. Remember, the president and his cabinet are currently in negotiations for trade agreements. We really have not seen major material agreements outside of a pause with respect to China, an agreement with the UK, which is actually in a trade surplus with the United States, and the most recent agreement we saw last week with Vietnam. But even that agreement showed an increase in tariffs beyond the initial 10% pause-related or rated tariffs that we saw. So things are going to get more expensive. Somebody is going to have to pay for higher tariffs, and there's only three people that could be the payers of this. One, the manufacturers in the regions. Two, customers, or three, corporations. And we think ultimately that higher cost will be split amongst those three payers.
Speaking of corporations, earnings season it will be upon us again before too long. U.S. earnings season, S&P 500 companies, the biggest companies in the world, by and large, will be reporting the results, providing commentary on conference calls. What will you be listening for or reading for from those conference calls, from executive commentary this quarter?
So I think earnings season is really important to acknowledge. That is going to be a key catalyst over the next 3 weeks, particularly if you don't see trade agreements. And what we expect to see is actually fairly decent earnings growth coming out of companies for the second quarter. But remember, that is still backward looking. They're still benefiting from a lot of the front loading that happened when people were trying to, or companies were trying to get ahead of tariffs, and also consumers. I think you will continue to see uncertainty talked about with respect to the guidance. But one thing that you will see is, remember, certainty is relative. And when you think about where they were in the April time period when they were reporting the first quarter of earnings, uncertainty was at a peak because this was just after Liberation Day. So I think on a relative basis, you'll hear companies be relatively more positive, but I don't think they really have actually more visibility coming into the second half of the year when it comes to how consumers are going to spend, businesses, how they're going to make large capital decisions, and generally the outlook for their margins, because tariffs have moved from an average rate of about 2.5% to about 15% today based on what we know. So eventually this is going to have to be factored into company margins.
There's been a big piece of legislation passed recently in the United States. It's controversial in terms of what it does to the fiscal picture in the United States. Are investors paying enough attention to the so-called one big beautiful bill, and more to the point, the tax cuts that are inherent in that legislation and the implications for the U.S. fiscal position in the future?
I think that investors are definitely paying attention. We started to see an increase in yields again, and so that's starting to show through the impact on the deficit and potential debt situation in the United States. But I think that investors are relieved. I think there's a sense of, okay, now we know that the corporate tax cuts are here to stay. There are also great incentives when it comes to spending capital, either capital expenditures or R&D for tax deductibility. And that's actually very good and can be very stimulative for the U.S. economy. So there is a bit of a push-pull. Some aspects of the bill are very good for corporations and equity markets. But on the other hand, to your point and your question, increasing the deficit and debt is not very good for the outlook for bonds. It just means more issuance into the future and potentially higher rates with more supply.
Okay, you think more market volatility is possible in the second half of this year? What, in terms of a sector perspective, what sectors of the U.S. market do you think might do better than others?
So I think coming back to your question around complacency, I think that there has been complacency, and right now there's sort of maximum optimism, and we're seeing that with markets near all-time highs. So when we think about greater volatility, we see that what will likely be impacted are the things that have done the best. So this is areas like technology, or the Mag 7 has been a big driver of the S&P 500 returns. So when you start to see more volatility, where you will see benefit is, and this is a bit of a contrarian call because this is not where the momentum is right now, but is in more defensive areas. So as volatility comes in, investors will favor things like consumer staples, like utilities. And so if we start to see more volatility, we start to see a move back to the defensives that we saw earlier this year in that March-April sell-off.
It's been a very good year, obviously, for Canadian stocks. Can that continue in the second half of this year?
Well, Canada is an interesting story. First of all, Canada will benefit if the U.S. economy does well. Of course, we know that. Canada, the Canadian stock market, is not so levered to the Canadian economy.
Right.
Having said that, I think Canada is in a particularly good place as well when it comes to the fiscal side, because we know we see a roadmap to more of a pro-growth view with respect to our government, and where investment and fiscal spending is going to be much more focused on actually stimulating the Canadian economy. So I think there is a backdrop for some sectors in Canada. Financials, for example, have very much been driven by non-bank financials year to date. I think you'll start to see the banks perform very well in an environment where there is a strong fiscal impulse here in Canada.